All right, man. Well, thank you for coming.
You're welcome.
As proficient BD people, business development people, like we've seen each other at a couple of events over the last year anyhow. And we were having a conversation about what you guys do. And I found it interesting. Using the term interesting kind of loosely, right?
Right.
But interest, yeah, from
Insurance.
the perspective of trying to help companies get financing. So maybe we'll start by having you introduce yourself.
Sure. Thanks. Thanks for the opportunity to have a conversation. My name is Barry Kenley. I'm Vice President of Sales for Allianz Trade. Allianz Trade is an insurance company. We are part of the Allianz Global Enterprise. In Canada, we are operating right across the country with about 65 associates. I manage all of our business here in Alberta and British Columbia. And really what we do is we provide trade credit or accounts receivable insurance so that if you are selling a product to a client or performing a service for one of your customers and they either can't pay or choose not to pay or they default or they go into bankruptcy, and as long as we have the ability to insure that particular company, you can file a claim for that non-payment of invoice and we will pay that back to you.
Yeah, so over the years, there were two big ones that I was always aware of at TD, right? There's EDC, which is Crown Corp, and then Euler, which is that's all you guys, right?
That is us. That's our previous name. We were the way the organization happened is that we've always been owned by Allianz. However, they had about 17 or 18 different global entities, each one operating under their own specific name when they were formed. And Euler Hermes was the original name of our company, formed about 135 years ago. And in 2018, Allianz completed the ownership of the whole Euler Hermes group. Last year, 2022, Allianz Global decided to complete a complete rebranding exercise, and all of their various entities became Allianz something. Allianz Health, Allianz Life. We became Allianz Trade because technically that's the vision and mission of our business is to help our clients grow and to help them make money or save money. So we became Allianz Trade. So that name happened March, April of last year.
Right. So at the most basic level, like this is insuring accounts receivable against non-payment, right?
Correct.
But at another level too, this has working capital implications, right? Because if you're a business and you have a borrowing base, which means your lender is advancing at some discounted value, usually let's say 75% against your eligible AR. Mm-hmm. If you have eligible insurance, which just usually meant it was either EDC or Euler, you would get in most cases you would get enhanced availability. So instead of 75%, maybe you get 85%, right? And so I don't think a lot of people think about that piece so much. They just think about, well, I'm not worried about my customers defaulting, so I don't really need this. And I don't think they think about the benefits of the additional working capital availability and the implications of that, right? And that was the conversation we were having that I found kind of interesting, because usually businesses they look at AR insurance, they'll get hung up on, I didn't really like the premiums, I didn't really see the benefit. Right. But let's talk about the benefits a bit more on the working capital piece, like educate people a bit more on this.
Yeah, for sure. So at the end of the day, trade credit insurance has three key benefits. Number one, you mentioned with respect to any type of a default or non-payment, something happens to your client, they can't pay you or choose not to pay, you can make a claim and we'll pay you back. Secondarily, and one of the most important benefits, especially in this particular market, is the opportunity, as you mentioned, for our clients to access additional working capital. So as you mentioned, if they do have a margined operating line or facility with a lender today, you're right in the fact that they're getting about 75% on whatever that lender deems to be current AR.
Non-investment grade, yeah.
Right, non-investment grade. Sometimes with investment grade, they may provide a higher amount to that respect anyway. So what having a policy will do is it will allow lenders to increase that margining from 75% of outstanding AR to a minimum of 90%. And the reason for that is that we pay 90% of a claim. So let's say you have a sale, you have a loss, the client goes bankrupt, and they owe you $100,000. As long as we're able to insure that particular company, we would write a check to somebody for $90,000 on that particular loss. So when the banks and the lenders are involved, they become the beneficiary of the policy. So if they're providing that extra working capital, then there's a loss that's related to that particular business. We would make the check payable to the actual lender. So therefore, they can now bump up that margining percentage because they're covered at 100% of mitigating their risk. Yeah. Now, we also have some clients that we've actually looked at 95 or even 100% coverage on behalf of the lender. But of course, those types of buyers that the companies are dealing with are government agencies, some of the major retailers like Costco's and Walmart's.
Like undoubted customers.
Yeah, absolutely. So some very, very strong investment grade. But who really knows who's investment grade today? Nordstrom is a prime example. They are risk rated as a 1, which is the best in the U.S., and all of a sudden they're gone in Canada, and a lot of people lost money on that. So that's kind of the second benefit, is the ability to enhance your working capital. And the third one is really from a growth perspective, is that if you're looking to export to foreign markets around the world, most lenders wouldn't provide any working capital against those receivables without some sort of insurance on them. And secondarily, if you're a credit manager and you're selling to ABC company, but you don't have a lot of information on them and you're only comfortable giving them a credit line of, let's say, $100,000 at any given time, they can come to us and say, what do we know about that particular company? Can you give us some history? Do some due diligence for us? And we may come back and say, you know what, we're comfortable with giving you a limit of $500,000. So that if you have that ability to sell them more, you've just chosen not to. Now here's your chance to enhance those particular sales. So that's really, from a benefit perspective, what a policy delivers. With respect to the working capital, it's really an ROI. As you mentioned before, does anybody need any more insurance? No, absolutely not. But from our perspective, it's really, if I can put a policy in place and it's going to allow my lender on a $2 million operating line to give me another 15%, so let's call it another $300,000 by having a policy. And if I have to pay $15,000 a year for that policy premium, that's kind of a 20-to-1 ROI on that initial investment. So I think it's worth it as a hurdle rate to invest that $15,000 for the extra $300,000.
Well, I was talking to an even larger company, think about 20 million of AR. Mm-hmm. And I was like, honestly, man, and they were talking about, so what I find it comes up a lot is a lot of people ask, oh, hey, have you ever seen anybody margin whip or unbilled AR? And I'm like, honestly, man, no. And there are reasons why.
Right.
You're better off trying to push the advance rate on the eligible stuff to make up for that shortfall, right? And so in this particular instance, 20 million of AR, I was like, imagine if you did get an extra 10% of working capital. Oh. So yeah, if you're just going to let the availability sit there, I get there's not really a super compelling ROI argument there, but go and buy a business, an extra $2 million bucks, conceivably, that's like a $6 million tuck-in acquisition or something like that.
Right.
What is the return on that?
For sure.
Usually it's 20% on private financing, private deals, right? So
100%. We agree with that. That's part of our overall analysis of the business is that, okay, if you have the ability to access an extra $1 million, $2 million, whatever that number is, what do you do with that money when you have it? Number one, sometimes you just have to pay your operating expenses because your clients are taking 90 or 100 days to pay your bills. Sometimes you have to work with your vendors because they're asking for payment of your raw material earlier. Sure. And especially over the course of the COVID issues with supply chains, that you would go back to your vendor and say, I need, some drywall or I need some chairs. And your vendor would say, look, I only have 50, even though I only need 10. I don't know if I'm ever going to get any more. So you better buy them all now. So all of a sudden there was a big cash crunch because people needed to come up with money to help finance their inventory, raw materials in anticipation of future business when they didn't think they'd be able to access and acquire that kind of product at the time. You mentioned work in progress and holdback. So actually, we did a deal about 3 weeks ago with a building company who's doing a lot of work in the construction world, commercial construction, Alberta and BC. It's about a $300 million gross sales company. They have roughly 10% holdback a year, which is, $30 million. Mm-hmm. And their lender was not providing any working capital against that hold, which, because it's, from a banking perspective, it's like, holdback, you're never going to collect it. Or, we know we owe you 10%, but we'll give you 6% and go away, right? Let's just call it even. So in this case, we put a policy in place. The buyers were all fairly strong. So we were able to put in place what we call our holdback or retainage endorsement, which allowed the lender to now provide 50% margining against that, that holdback, $30 million. So they were actually able to provide an extra $15 million in working capital. Sometimes banks will and lenders will look at a percentage. It may not be 90, it may not be 75, but even in this case, it was 50, and it was 50 more than the company had yesterday. So for them, it was a no-brainer to access that capital.
That availability was coming on as they were getting closer to the end of the project.
Right.
Yeah.
But the other thing we did for that is this is the only time in Allianz Trade's global history. In fact, we had to get this deal approved by our group office in Paris because the holdback allowance had to encompass a 2-year period. So they would do a project, but the projects themselves were 18 months to 24 months. Wow. So they could start today, but they may not have a holdback invoice issued until October of next year, which is kind of exceeds the term of a credit insurance policy. Mm-hmm. So we had to make the policy 2 years and make the holdback period 14 months. The bottom line is we got everybody on side and we got the deal done. So it's pretty interesting. So now they're going to have access to a ton of additional working capital to help finance their projects going forward.
When a company is contemplating this, how do they're gonna look at their AR list and they're gonna want to get a sense of like, hey, how much of this is actually going to be eligible?
Right.
Like, are there broad strokes criteria for the type of businesses and the type of receivables that make the most sense?
It depends on the industry. We can dissect the company's sales in a number of different ways. And even when it comes to putting a policy quotation together, one of the things that we do is we kind of analyze who their buyers are. Do you really need to give us insurance premiums on somebody who is an investment grade type of client? So if you're working for, the Alberta provincial government or, Alberta Health, AHS, you're not going to have an issue with default on those particular companies. Your lender may give you 90% against those anyway. So what I would do is just back those sales out of our coverage. Mm-hmm. You don't need to give me the premium to pay us to cover when you don't really have the opportunity to realize a true financial benefit on insuring those companies, because the default is not going to happen. Your bank and lender is going to give you 90 anyway. So let's just remove those from the equation. So we have the ability to pick and choose which companies and the requirements against those in order to ensure to provide, the maximization of coverage in case of default, because anything could happen to anybody. Yeah. Or, what is that financial differential number on the margining that you're looking for on your facility, and how do we help you get to that so that the lender is covered, their risk is mitigated, and they can free up that extra working capital.
Are there instances where you put a policy in place, but for whatever reason the lender doesn't provide additional advance rate?
Sometimes that happens. It all depends on, the relationship of the lender and the client.
So is that like would it be special credit situations where that's most prone to happen? Or
so in some cases, we have clients that work with the general commercial teams of most financial institutions. I have some clients that work in the special loans areas. And, a couple of years ago, when the traditional interest rates were higher than they were, maybe 5-6 years ago, if you were not, a business operating in the special loans area of a lender's portfolio, they would probably be charging you somewhere in the range of 7, 8, 10% borrowing, when the standard rates at that point were maybe 2 or 3.
Sure.
So really the benefit from having a trade credit policy wasn't going to allow the lender to put you back into the general commercial teams, but it helped to lower the interest rate that they were charging. So we put some policies in place. They were able to lower the rate from traditional 9% to about 5 to 6 in that range. So at the end of the day, you'd pay me $15,000 for a premium, but your interest rate could probably save you $400,000 a year in financing costs. So again, when you do the math, do I spend $15,000 to save $300 or $400 of interest? Absolutely. So
and that's because the receivable is no longer subject to the customer's credit risk. It's your business.
Right. Yeah. So what we do is, we don't actually buy receivables. We're not like a factoring company.
But because you effectively
we backstop
insure it.
them.
Yes.
Absolutely.
Yeah.
So as long as we can provide a limit and an approved credit limit for that particular company, then the company is assured that they'll get paid, and then the lender is assured that they would get paid if the company goes south.
How long does somebody have to chase the receivable before making a claim? Because obviously you don't want to trigger some moral hazard situation.
For sure. So there's 2 scenarios. So number one, if your client has actually gone bankrupt or filed a notion or intention to restructure, and you receive a letter from a trustee in bankruptcy or a lawyer or accounting firm saying, this company is no longer going to be operating. You're on the creditor list. They owe you $50,000. Good luck, right? We'll see you in court in 10 years, and you'll get $2,000. Yeah. So once they receive that particular notification, and if we've insured that particular company, then our client can file a claim right away. If the company is no longer a going concern, it'll take us about 30 days just to review the paperwork and get that through the system. And then we would write them a check and deliver a check for whatever the loss happens to be. Now, we also pay should a company just decide not to pay the bill for whatever reason. We call that protracted default, whether it's just dragging things out or it's, pay when paid from their understanding, or maybe their client's not paying them, so how can I pay you? So the only difference with that scenario is that if your buyer is insured by us and they are still a going concern, then technically you have to give them a cooling off period of 60 days past your due date. So let's just say your normal terms on that invoice are net 30. So day 91, if they haven't answered your phone calls or responded to your emails and you don't know if you're ever going to get paid, so 60 days after your expected due date, you can file a claim.
And then assuming it's covered 30 days from there.
Yeah, usually 30, 45, because what happens is if the company's still in business, then we have our own internal claims and collection team. They would reach out to your buyer and say, hey, what's going on? You owe our client $100,000. It's now 60 days past due. Do you have the ability to pay? Can you pay? Will you pay? Yeah. And depending on the response we get back from them, we'll determine our next step. So if it's, my client said they would pay me, I have no idea when I'm going to get paid, so I don't know if I can pay your client. Mm-hmm. So then we have the ability to pay our client for the loss. I mean, that's the reason for having insurance, is to make our clients whole. And then we would basically take their place in line and work with their buyer to say, okay, we've paid the invoice. Now you owe us the money. Pay us when you can, 6 months, 2 months, a year. Put a plan in place, pay us $1,000 a week, I don't know, whatever it is. Mm-hmm. So that's something for our claims collection team to iron out between all the parties. But at the end of the day, we do our best to try to pay our clients, and then we'll take on that debt following to try to collect that back.
So in this situation where the company hasn't necessarily gone into bankruptcy and issued all the notices, getting paid is kind of a plus or minus 150 day.
Usually about 95 to 100 days, if they're still ongoing.
After the net 30 days?
Right.
Yeah. Okay.
But at least they'll get paid.
Yeah, totally. Are there examples of non-covered events? And the reason I asked that, I asked that because we both know this company, but construction financing, you have progress-based AR, and there's this idea of set-off risk, right? If your customer fails mid-project, then their customer, the counterparty, might refuse to pay any of the outstanding receivables, and it's kind of a contract default in a way. Like, I'm assuming that's not a covered event.
It all depends on the circumstances that lead up to that. Now, if it's just an issue where the end buyer has paid your client and they're not paying you for whatever reason, then you can file that claim. But you can't go after the end buyer. If they say, look, I've already paid, let's call it a GC, right? And that's who you're invoicing. So that's already taken care of. So then our perspective is we would look at it and understand why your client hasn't paid you at the end of the day to pull that together. But if it's just like, dispute over contract law, or if you're supposed to paint something blue and you painted it green and your client isn't paying you, from our point of view, anything that has a remedy attached, so all I have to do is, go back to pick up some green paint and repaint it properly, and then I'll get paid. Yeah. Or, I drilled a hole over here and it was supposed to be 4 feet over on this side and I'm not getting paid. So sure, you got to fill that one in and drill it, according to the scope of work that you've undertaken. So those type of things, and again, we'll work with all the parties to understand the issues around the non-performance or payment, go from there. We also have a surety department that will put bonds in place. So, for example, if you're in a construction company and you're doing work for any level of government, municipal, local, provincial, they would almost 100% require you to take out a surety bond, liability performance bond. So if you can't deliver on the contract we've agreed to, then I have the ability as the party that hired you to cash that bond, and then I can go now hire your competitor to finish the job because you couldn't do it for me. Yeah. So the difference there is that when we review a client for surety, we're reviewing our client to make sure they have the ability to complete the task and the job and hopefully not have any kind of financing or issues along the way, that their client wouldn't necessarily cash that bond and then go to somewhere else to get the job done. So lots of different scenarios when it comes to that.
Sure. Yeah. So what you're saying is for AR insurance, that's really based on the counterparty's balance sheet.
Correct.
Surety bond, more on the customer's balance sheet. Like, it's more of a direct underwrite, right?
Exactly. That's what it is. Yeah. We have our risk analysts around the world, and, normally we'll get a list of buyers from our clients saying, I'd like to cover these 10 or these 20 companies, and here are the specific limits I need, which really is how much outstanding would you have at any point in time with these companies. And so my risk analyst will kind of review financials of the buyers. We'll look at our own network and history. So do we have any other policyholders that already have existing coverage on these same companies? And if so, has anybody reported past due invoices or taking forever to get paid or any other defaults over the history of the company? And then based on that, we will determine our ability to insure that particular company for the amount our client has asked for. Sometimes it's, okay, sure, we can give you whatever you're looking for. Sometimes I can give you 3 times what you're looking for. Sometimes I can't give you anything on that particular company. So lots of different scenarios come into play.
Are there concentration limits on stuff like this, or is it strictly just the counterparties?
Yeah, where they are. And,
so it could be one customer for one business. Doesn't really matter.
Yeah. So we can actually put a policy together just on we call it a single buyer deal. So if you've got a big contract with one company alone, we have the ability just to insure that specific risk. There are a few different caveats that come into play from the corporation's financial perspective, but we can definitely consider just, one buyer. We can look at one project, a couple of projects, specific countries. As I mentioned earlier, you can exclude certain companies if you don't think there's any downside risk to that. We're pretty flexible to provide that, whatever the company's looking for.
It's an important distinction too between you and EDC. Like, EDC is entirely export related. It can be indirect export.
Sure.
You don't have that requirement.
We don't. So, with EDC, we are both collaborators and competitors from a global perspective. We're a global company. We have 65 offices or 65 markets and countries around the world. One of the benefits that we can bring to the table is that if you're looking to export and you're looking to sell to, Bolivia or Australia or anywhere around the world, and you're looking for due diligence information on buyers in those markets, we would have our own in-country risk analysts, do the write-up and take a look at the company, and we get a much tighter analysis of that particular buyer to be able to hopefully insure them on behalf of our clients. Mm-hmm. But there are certain instances where we've actually worked with EDC on syndicating deals together. If we have a client in a country that, maybe our risk appetite is limited to, let's say, $500,000, but a client may need $1 million coverage, we could go to EDC and, can you backstop us and come into our deal and provide an extra X amount of dollars to make the client whole. And many occasions, especially during COVID, when, they were able to help backstop a number of different limits where we couldn't provide 100% of what the clients were looking for.
And I imagine if the customer doesn't know themselves, like you can provide some insight into any sort of sanctioning limitations too. Because I honestly don't know. Outside of the news, like there's probably there's some countries I've never heard of that are on sanction lists, and I don't know how I'm personally supposed to monitor this.
It's interesting. I just actually asked one of my risk associates last week for a country listing because we rate countries by risk, based on letters from A to D minus in terms of the creditability to pay and political risk as well. So we just actually have a brand new list that came out at the end of July.
Canada is not on it, I hope.
No, so the number of like Canada, Australia, the UK, United States, all of those types of companies, Germany, political risk is really not even a thing at the end of the day. So those are kind of
despite popular belief.
Absolutely, anything can happen at any given time. But at the end of the day, those are fairly stable government regimes. Never mind whoever's running the show, but that's another conversation altogether.
Sure.
But we have the ability to look at, you talked about industry. So, different industries come with different risks associated as well. And I'll go back to COVID. So, in January of 2020, prior to COVID, we had a ton of clients that were selling to the cruise line industry. Norwegian Cruises, Carnival Cruises, Pacific Princess, and they were selling anything from, food service, catering, bedding, linens, all sorts of things. So all of the cruise lines were rated, as a 1 or a 2, which were kind of stellar. You want $1 million? You want $50 million? No problem. Yeah. March comes along and the cruise industry is decimated, and you got a number of, ships that can't dock anywhere around the world. So overnight, the credit rating for the cruise industry went from a 1 and 2 to 8s and 9s. Yeah. And we are no longer, our limits were all cut almost by at least 90%, sometimes 100%. And now that's all come back over the last couple of years as that industry has increased. But we're nowhere near. We're maybe 40% of where we were in 2020. The same with the energy companies. March of January of 2020, oil was $80 a barrel. March, April, it was minus 30. So it's like, here's a barrel, and there's a $30 bill on top of it, which you can have, right? So the same thing. We had limits on some of the big producers and big drilling companies, and all of those limits, tens of millions of dollars, were cut by 60, 70, 80%, just because who knew what the risk was. Now, everything is back to normal, especially in this market here. We've done deals in the last 6 months where we're able to approve 100% of coverage on, some of the major players in the energy world, whatever you want. You want, $50 million on, for example, CNRL, no problem.
When those limit reductions happened in COVID, did that impact existing customers?
It did, because we as an insurance company had to kind of limit our own liability in that sector. So, and it's based on, as I mentioned, some of those companies have risk ratings between a 1 and a 10. Yeah. And we have, in each of those categories, we have certain limitations of how much coverage we can provide to a company that's rated as an 8 versus rated as a 2. Yeah. So we had to cut all of that back. Again, there was no real forecast, and operating costs were out of control.
Everybody was freaking out. We thought the world was over.
No revenues, absolutely. Yeah. But of course, things kind of righted itself and back to normal.
Yeah, we're waiting for the next black swan of that.
Yeah, who knows? The difference also, if I can mention, sort of out west here in Canada, our market is very different for me and for my portfolio compared to what's happening in Eastern Canada. with Quebec and Ontario, there's a ton of manufacturing where they have, women's and men's clothing, pretty big markets, and manufacturers in Montreal. Ontario is huge in auto parts manufacturing, a lot of companies that are selling value-added services. And all of those companies that we have as policyholders all have 1,000 buyers, selling to retail stores, they're selling to all sorts of, automotive dealerships. So they know that 10 companies are going to go bankrupt next month. They don't know which 10, but they figured out, let me get a policy and insure all of my business because I'm making all these sales. I have good cash flow because I've got so many buyers, but I know I'm going to have some sort of loss. So let me insure them all. Whereas here in Alberta and British Columbia, we have major companies in major industries like the construction business, the ag business, the energy sector, the lumber sector, where our clients and policyholders only have 10 or 15 buyers for big limits, $1 million, $20 million limits. And at the end of the day, the risk on those companies are rather small. Are they going to go bankrupt? Are they too big to fail? Who knows, right? But the odds are they're still going to be around. The issue for them is that if you're dealing with anybody in the energy sector, they've all sent notices saying, look, we're going to pay you a 90 or 120. And if you don't like it, we'll find somebody else to do the servicing for us.
They've been notorious for that for years.
Absolutely. Yeah. So for our clients, it's a matter of cash flow. Yeah. So that's why everybody needs that additional lender margining. And I can safely say that 75% of all the deals I've done over the last 9 years have some bank additional lending component in it. It's not about, I'm worried that somebody's not going to pay me. Not a thing. It's I just need that extra working capital. As I mentioned earlier, either to buy inventory, pay my bills, but you and I also had that conversation recently is what do you do with that money? If I get an extra $500,000 that I didn't have yesterday, maybe I can hire 3 or 4 sales associates, let them go out and maybe bring in another $10 million of revenue.
Yeah, that makes a lot of sense to me. Also, too, like if you're tight on your borrowing base, you can't really put a dollar value on avoiding a default, right? That's a big issue. For Defaults are a problem.
Absolutely.
They get waived on occasion, but like a borrowing base, like you need to figure out how to resolve it, and so it becomes a whole thing. And I don't know how you put a number on that, but it's probably somewhere around priceless.
Oh, absolutely, and especially if your margins are really thin. If you're only making 5%, and you lose $1 million, you basically have to have another $20 million in sales just to break even on that $1 million loss.
Have you? This is kind of unrelated. Have you ever worked in Toronto in that manufacturing stuff?
I have.
So when I was in Toronto for a year with the ABL group, so they do a ton of manufacturing, and we went out and did a trip out to Windsor to visit one of the customers, and I was blown away by how many different suppliers are involved in building a car. Like, not even the car, just like take a component, like, I don't know, the headrest or the seat. There'd be like 10 different companies involved. And I was like,
100%.
Is that necessary? Like, not that I know how to build a car, but it just blew me away.
It's crazy. So just, as background, I was born in Montreal. I was there until I graduated university. I moved to Toronto for 27 years and worked in Toronto. I worked for American Express at the time as director of sales for many of those years. One of our clients was Magna Industries. So Magna is, the auto manufacturer, and they are more of a consolidator. They don't actually make their own car, but they will make components and parts to sell to all the major manufacturers. You'd be surprised, when you go see their facility. I mean, it's unbelievable. The automation, the way it works, but just the sheer volume of pieces that you can buy for everything, like every trim level, every piece of chrome that's in a car or black or whatever. It's crazy. I mean, it's 15,000 pieces that go into an average car. Somebody's got to make them.
Totally. Hey, from an application perspective, like what does the process look like when somebody approaches you?
Sure. So it's actually a fairly simple process, and we get approached by clients directly who come to us and say, I just want to protect my business and I want to look at some additional opportunities. We have the broker network, so insurance brokers can also sell our products as well as part of their overall portfolio of their property casualty insurance, home, life, auto, and so on. They can sell trade credit as well. And then we have a lot of commercial managers and all the bankers who are our friends that say, I have a client that I think, should you be able to put a policy in place, we can lend them, X amount of additional working capital. So we think it's a worthwhile investment to consider that. So the process is fairly straightforward. I've got a 3-page application, just, quarter of a page of your company information, a section on, have you had any bad debt losses over the last 3 years? What do you think your forecast is going to be for sales for the next year? Give me a list of your top 10, 15, 20 key buyers. And so those are kind of the larger companies that if you were to experience a loss, it could materially impact the company. Maybe you'd have to sell a division or lay people off or sell some assets to cover that loss. Fill out the application. Send me a recent AR aging statement just to see where you are on your collection process. That gets submitted into our system. We have our risk analysts that will take a look at your clients and the buyers that you have requested a limit on. Usually takes 2 or 3 days. Now, if your buyers are public companies or if they're some of the larger players in the industry, we have many companies that are basically called auto-graded. So if you ask for a limit of, let's say, $1 million on Imperial Oil, that'll be approved in 3 minutes. Nobody looks. No issue. So it normally takes about 3 or 4 days to get my risk analyst to review all of the buyers, make sure we can or can't insure the specific limits. Once that's done, my underwriting team will look at the coverage levels, and then they will actually build a quote based on a couple of things. Number one, what are your gross sales you want us to insure? $1 million, $100 million, somewhere in between. Now, when we looked at each of your clients, and I think I mentioned earlier that they each have their own risk rating, we kind of put all of those into a blender. And then at the other side of that, there's a risk basis point calculation factor, which could be 10 basis points if your clients are good, could be 50 basis points if they're not as great. So let's call it 20 basis points on average, and you want us to insure $10 million of sales. So we basically multiply the 10 million times 20 basis points, which means the coverage for the year would be $20,000 for that policy. Right. But again, if you're doing, $10 million and you have an operating line of $1.5 million or maybe even $2 million if things are good, and you can add another $300,000 or $400,000 of working capital for $20,000 in a premium, it's probably worthwhile. A, to help you sleep at night, but sure. B, to access extra funding.
Is it a problem if you're speaking to a company and you just kind of get the sense that they don't really have much of a credit policy at all? Like they just kind of give credit to anybody?
You gotta have some sort of a credit, but we also act as a lot of our clients outsource credit management. So there's two parts of a policy. Number one, we call them the named buyers, which are those key companies, the larger ones, that will have a specific amount listed against them. So Imperial Oil, $1 million, for example. Then we have what we call our discretionary portion of the policy, which is a blanket portion that for smaller accounts, one-off sales, let's say you get somebody that you're selling to and it's a $10,000 invoice, and all of a sudden, they go south, you never hear from them again. So you have the ability to insure, let's say, up to $100,000 in various invoicing levels as a blanket policy. The only criteria in order to be able to have a company fall under that coverage is you have to do some due diligence. You've got to be able to get a credit app, maybe get a bank reference, get a trade reference, go visit their location. Does the company work out of a legitimate office, or are they working out of an F-150 in Fish Creek parking lot, right? So as long as you can understand who your clients are and you can show us, yes, here's the company, here's what I know about them, we did our homework, then we kind of give you the ability to sell and not worry if there's something that's going to happen.
Yeah, fair enough.
So minimal due diligence.
Yeah,
but something.
I'm guessing that there are probably an alarming number of companies out there that don't do much of any due diligence, but that's a speculation.
True.
For lenders, what relevant questions should they be asking prospects, potential clients with respect to AR insurance? Like they're trying to weed out which companies make the most sense here.
Yeah, I mean, at the end of the day, they have to understand who that company's buyers are, and they have to understand the industry that they're in, the standard and normal terms of payment of that industry. So when what's the cash flow look like? What are the expectations of selling something, providing a service, invoicing, and when am I realistically looking to collect, on that invoice? Is it going to be 30, 60, 90? If I'm exporting products to the Middle East, for example, if you're selling to UAE or Dubai, your normal terms of payment, unexpected for payment, is anywhere from 120 to 210 days. So, and that affects the ability to make a claim. So if you sent, downhole drilling tools to UAE and your normal terms of payment are net 60, and if you're not getting paid, we have an internal waiting period of 180 days on UAE. So technically, you've got to wait 6 months past your expected due date in order to file a claim, because anything could happen within that 6 months. You may get paid, you may not get paid.
Why is UAE unique?
It's just the nature of the Middle Eastern business marketplace.
They just tend to pay slower. But they will pay.
They will pay, but at some point.
Yeah.
But you can't really call them and say, hey, it's like a half an hour overdue. Where's my money? It's not going to happen.
Touche.
So I think from a lender's perspective, they just need to understand, and I know they all do. And when you develop a term sheet, you really have to know cash flow projections, and you have to know expected revenue, and of course, match that against the company's own operating costs. If I'm potentially putting out a ton of money up front, that's out of pocket, and I've got to wait 90 or 120. From a banking perspective, is that even offside? Am I still going to have the ability to margin that particular invoice because now it's 96 days old?
Yeah. And
many lenders, deem anything over 90 days outstanding as either, I wouldn't call it non-collectible, but there could be an issue with collecting.
Ineligible, anyhow.
Ineligible. Yeah. So, and as you know, not only would they not lend against any of those invoices, but if those over 90-day invoices represent greater than 10% of your billing to that particular buyer, they won't even allow you to margin current invoices.
Yeah.
But what we have the ability to do is work with the lender's risk and underwriting departments and say, look, when a client insures ABC company with us, they're insured for a year. So we don't have any cutoff day of a 90-day invoice that no longer gets paid. You can file a claim for the full 365 days later, and if they met the criteria for reimbursement and for payment, we'll still pay that full 90%, on day 348 that it's outstanding. Mm-hmm. So the lender will always get their funds. From my perspective, it's always, when I talk to the banks and lenders underwriting team, it's like, why can't you go past 90? And I know it's
we just don't.
It's just a banking stance.
Or 120 you might get.
Maybe one. You're right. And there are certain projects and certain clients where, sure, there's definitely exceptions, but it's the exception rather than the norm. Yeah. Even though we have the ability to cover their business for the whole year, why would you cut them off?
Yeah, it's one of those things. I mean, maybe in corporate, larger deals, right? There's a bit more capacity to kind of think outside of the box. It's less policy focused.
For sure.
Mid-market, it's such a volume business. They're just like, I don't know, this hurts my head.
Right, exactly. I don't even want to bother. Yeah. It's a 91 days.
For a couple $100,000.
Right. Who cares?
What should we know about you personally? Because I think you said somewhere that you're actually a comic collector.
I am. I don't know how relevant that'll be to the audience, but
probably not super relevant. But.
No problems. Yeah, I've been collecting comics for 50 years, and I think I just hit the 10,000 threshold a couple of weeks ago. I'm still buying them. I've been doing it forever.
Is there some dark corner of the internet where you find this stuff?
No, it's all over. I've got connections, and I used to travel quite a bit for work, and still did, and I would know comic dealers and stores all over the place. I was in Kelowna last week for some business and managed to hit the 3 comic stores one morning when I was there, and just to see what they have. It's always the thrill of the hunt to see what somebody could have in their shop.
Is it like what drives value? Is it the limited prints initially, or
At the end of the day, back in, let's call it the early 60s, when all the major comic superheroes kind of came to prominence. On the Marvel group, there's a Fantastic Four and Thor and Hulk and the Avengers and DC. I mean, DC started in like the late 30s and 40s, but really the late 50s, 60s. Their print runs of comics were $30, $40, $50,000. 50,000 units compared to the 90s, where some titles of, X-Men, they printed like 7 million copies. So, between parents throwing out comics back in the 60s, who knew what values of anything were at the end of the day, right? So it's really scarcity has driven that. The other thing that's really been a big driver over the last couple of years has been the Bitcoin market. And the reason for that is, 2011, 2010, 2012, when it first came out, you can buy Bitcoin for $15, $30, $50. Yeah. So you spend $1,000, you get 700 shares of Bitcoin. That's $21 million today. Mm-hmm. And it would have been $40 million 3 years ago, right? So you get all these millennials, and I know my kids are included, who have all this cash flow, and they're buying, Michael Jordan rookie cards and Gretzky and Tom Brady cards, and they're buying comics, and they're buying NFTs, and they're putting money into, crazy investments, and the prices just hit the roof. There's probably the best auction houses for comics is called Heritage Auctions, okay. And they sell everything from original artwork. So, for example, Amazing Fantasy 15 is the first appearance of Spider-Man. So every page that Steve Ditko, the artist, drew, like 8 or 9 pages, is going for like $2-3 million a page for that. Superman #1 and Action Comics #1 has gone for $4 million just because somebody can buy them. I mean,
I find it really interesting that in order to be a superhero, you had to have some sort of issue with your parents.
Yeah, that's part of it.
That or they got killed or something.
Right.
And I'm curious what the genesis of that is. Like there's something to that's right. Compelling with the audience, right?
Yeah, so I can give you a little bit of an example on that. So when it comes to Marvel, like Stan Lee and Jack Kirby, who invented, the Hulk and Fantastic Four. Yeah. So, their own personal backgrounds, right? They came out of World War II, and Stan and Jack was actually fighting there. But their, whole families were persecuted, and what they wanted to, impart in when they created these superheroes was to have real world problems with some of these heroes, or even Superman, came out of the fact that Siegel and Schuster were bullied as kids, and they decided to create a superhero who would be the embodiment of what they thought their life should be. Mm-hmm. Batman too. Sure, there was a lot of dark areas that a lot of superheroes. You're right. His parents were killed and kind of witnessed that, and all of a sudden
cannot
he grows
get
up.
over it. Like get over it, man. Like 40 years old now.
Exactly. Oh, it's even worse. I mean, but and then there's a whole Batman comics who were like resurrected. The Dark Knight Returns like 10, 12 years ago, which is a whole
Frank
Miller stuff, and that created a whole new audience for any of that. But the universe keeps expanding, and now there's multiverses with different superheroes all over the place, and you can see. And the other thing that's really driven it over the last 20 years has been the predominance of the movies. Yeah. Especially when it came to like the Marvel movies, the Avengers and Iron Man, Captain America. It's been great for comic collectors because, as an example, the first appearance of Doctor Strange was in a comic called Strange Tales 110. 1963 is his first time ever in print. So that comic was kind of run of the mill. You could buy one for a couple $100, $200-$300 a few years ago. Now, since the movies come out, and since he's now a mainstay in the universe of all the Avengers movies, that comic is going for like $6,000. Wow. And like everything has gone up. So, I do it, I collect because it's a bit of nostalgia, stuff I grew up with, and stuff that I just want to have. I got to work on an exit strategy at some point. How do I get rid of all this stuff and take it with me? You can't really take it with me. Mm-hmm. But it's just fun. But I'm still buying stuff today. I bought new stuff on eBay yesterday, and some dealer in Manitoba who's a friend had something I was looking for, and they'll call me and say, "Look, I just got this in, or I just found this, and would you be interested?" And sure.
I'm really fascinated by people with intense hobbies.
Sure.
Do you know what I mean? Like something outside of work.
Right.
I just think there's something about that dimension that I find super compelling. It could be anything. It doesn't have to be something I'm into.
For sure.
There's a guy BMO. I'm gonna butcher his name, Barry Trottinger. I forget.
Oh,
anyhow,
sure.
Yeah. So
I know Barry.
Get him talking about smoking.
Oh, okay.
It boggles my mind. You can just add levels to anything if you spend enough time on it.
Right.
So anyhow, it doesn't matter what it is, but if you don't have a thing, I'm like, oh. Right. So anyhow, I find the comic book thing really interesting.
No, it's fine. I mean, you're welcome to come over and check out the office. It's pretty interesting. I keep everything managed and organized. I've got
you would have to, yeah.
Inventory programs online that change weekly with updating values and different things. But at the end of the day, I'm a collector. I don't sell. I've never sold anything.
Sure.
So I guess some point I will, but who knows? We'll see. It's fun. I like it.
Where can people find you online, man?
Basically at our website for the company, which would be allianztrade.ca. Number one. Anybody can always email me at barry.kenley@allianz, ALLIANZ-trade.com. Or our phone number is 403-831-9117. I'm always available to meet or have a conversation. Again, as I mentioned, I manage all of Alberta and British Columbia. We're pretty open and flexible when it comes to reviewing companies and providing presentations and talking to all parties, comfortable talking to lenders and finance people and to clients and to buyers, insurance associates, and just kind of try to spread the gospel of trade credit insurance. It's the most valuable insurance nobody's heard of. And that's the key, is just awareness, letting people understand that it's available, and it changes a lot of things. But it also helps to save businesses. We had a loss in Ontario last year. A company lost $1 million, $980,000. One of their buyers, out of left field, just decided to pack up and leave. We wrote him a check for the full amount, and my associate Mike delivered, the big oversized Publishers Clearinghouse $1 million check, and that literally saved their business, from going under.
I definitely think it's one of these things that we don't think about, even from the lender's perspective. We don't think about as much as we do. We're in a rush, and it's kind of a secondary component to a deal. But whether it's covering non-payment or just juicing some working capital, sure, for productive use, right, or to avoid a default, I definitely think there's something here that we're not thinking about, right, as much as we should. Right. So right, thanks for coming on and educating us.
Thank you for the time. Feel free to reach out. Any questions or anything else, I'm always around.
Beauty. Nice job, man.
Thank you very much. Appreciate it.